Hello and a warm welcome to Portfolio Watch. I'm Gugulet Mfupi. Now in today's episode, we look to reflect on 2018, the year that certainly saw quite a lot happening. Everything from Ramaphoria to, of course, the pause on that initial excitement and substantial declines that we saw in South Africa's equity market. Despite all of this, as we head into 2019, what should we as investors expect? Well, to help us with these guidelines, I'm joined in studio by Andrew Ditburner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Dr Adrian Saville, Chief Executive of Cannon Asset Managers. Gentlemen, thank you so much for your time. I think the last time we got together and had this conversation, it certainly was under different times and in a different environment. But 2018 almost seems like the year that we want to forget. Do we, Andrew? Especially given that we started off with Ramaphoria, led to Ramaphosia initially, but of course just a sense of uneasiness with regard to the macroeconomic climate in South Africa.
Yeah, I think it's crazy to think we're almost at the end of 2018 already, and you can look back, it was almost a year ago that Steinhoff had their big blow-up in the beginning of December 2017, and I think since then, there's been a lot of nervousness out there in the markets, and if you just look at, the number of shares and some of the, well-known shares that have fallen, by vast amounts, 10% or more in a day over the past year have been quite significant. I mean, you can think of Anheuser, British American Tobacco, Capitec, EOH, the list goes on and on. So I think there's a lot of nervousness at the beginning of the year when you look at not just the local market, but I think offshore markets as well. The general view was that markets were fairly expensive, specifically the US. And despite good earnings that we've seen coming out over the last year, the US, I think, is pretty much one of the only markets around the world that is actually positive, but just marginally so. So last week we were talking about, US earnings, corporate earnings being up at about 28% to 8-year high. Yeah. Whilst that's been very good, the market is only slightly above water in terms of being in positive territory. I think it's up about 4% year to date. So I think we can look back and say that markets probably were a little pricey at the beginning of the year, but in South Africa we're down in the region of, I'm guessing, about 10% the last time I looked. And I think looking forward now, we would probably say that there's a fair amount of opportunity in the South African market if you know where to look. Last year we had a good year. NASPA's up 20% in 2017. This year it's down 25%. That carried the market last year. Sure. So I think if you look, specifically in the mid and small cap space now, I think there's a number of opportunities if you're willing to go into that space. Before
we even get into those opportunities, speaking of some of the big cap players in the South African market, of course, they've been rattled by many other pressures like the decline in the South African rand against the US dollar, which has fluctuated quite a bit. But of course, how have we seen this disconnect perhaps between a weak macroeconomic performance and fundamentals which have just seen our equities market not perform at its best? Adrian, feel free to jump into this one as well, because it does seem like there's a significant contrast between what we've seen locally versus international equities.
Yeah, I think, in the long term, we know that economic growth is what ultimately drives your corporate earnings, which in turn, plays out in investment returns. That's a long-term story. Yeah. In the short term, there's obviously sentiment, and you get this negative sentiment that, we had Ramaphoria in the beginning of the year. It's a perfect example. Here, everyone thinks overnight our problems are solved, and we see, some of the South African-facing companies, SA Inc. companies, doing really well. You look at your industrials, the banks, etc. Suddenly these guys are up 20-30% overnight, where on the ground nothing's actually changed, and that petered out very quickly. And then it was, Ramaphosia, Ramophobia, and now where we are at Rama reality, wherever it is, and suddenly we realize that things are not going to turn around overnight. But I think you've probably found it's now gone the other way. Sentiment's very, very negative. And maybe things are actually a bit better than what they were a year ago, but the sentiment right now is very low. So again, that creates your opportunity.
Yeah, I think that sentiment is global. It certainly hasn't been that way for the bulk of 2018. In fact, for a lot of 2018, the US was doing a tremendous amount of running, helped by a buoyant economy under Trump, tax relief, steady interest rate progression, strong currency. And so the US has been globally the darling, but that's come to a quick halt. It's been interrupted by the recent correction, and even then, the US still remains a long way ahead of other global markets. But the negative sentiment that Andrew's making reference to, I think I would agree with the suggestion that it creates some quite interesting opportunity, possibly in the global markets. One of the most interesting amongst the advanced economies is Britain, the British market, where Brexit has put a lot of pressure on those British stocks, and not just domestic British stocks, but British stocks facing outwards too.
Yeah, we think about that locally with our local companies that have exposure to their famous brands,
Absolutely.
Netcare, even to the likes of Discovery and Investec too, that also
the
play a bit of a role.
businesses.
Is that still expected to continue though? There's a looming uncertainty in the market, and if so, how should we approach this as investors, bearing in mind that we're moving into a whole new year, new investment outlooks, and how that should actually contribute to our asset allocation strategies?
So there's a big question mark over how Brexit ultimately plays out. We a little closer to some clues about what the end game looks like, but we're still guessing. And one thing markets hate under all circumstances is uncertainty. They don't like guessing. And the greater visibility, better line of sight they have. And so Theresa May, I think, will work her way towards that, and we will have that certain outcome, even in very bleak scenarios or negative scenarios, down case scenarios. I think those British stocks look attractive.
British stocks looking attractive at the moment, but we're always keen for opportunity everywhere. Before we do take a look at individual equities that we should look into, Andrew, perhaps give us a quick highlight of sectors that have seen significant bleeding. I know the tech stocks in the US, and maybe an interesting resurgence of mining stocks in South Africa, which appear to have been performing fairly well.
Yeah, so I think if you look back, there's been nowhere really to hide, specifically in the local market. The only place that has actually done relatively well is resources, as you allude to. So I think we've seen some of these, your bulletins, your Mondis have actually done really well. So your resource companies have done quite well, whereas if you look across industrials, financials, large cap, mid cap, small cap, they're all down in the region of 10, 15%. So there hasn't really been too many places to hide unless you were overweight resources, which very few people I think have been. Specifically what's happened to resources, I think 2 years ago was probably the best time to be buying resources, and everyone, the sentiment was negative. It's the British American tobacco story today, or the Anheuser-Busch. There's big negative sentiment, and as a result, you miss the opportunity. When you look abroad, as you mentioned, some of these US tech stocks are looking really attractive. I think if you look at the likes of Amazon, Google, Facebook, they're all, Netflix, they're all well off 20% from their 52-week highs. If you believe that the growth story remains intact, and there's some question marks, around the likes of Facebook, what's happening with Facebook at the moment, but if you believe that the growth story remains intact, then it might create an opportunity. Valuation is obviously still, very, very important. We believe that, some of these, we still do hold Amazon. We cut our position in half at about $2,000 a share, because we thought, whilst we liked the story, it was just very, very expensive. But now with trading, I think, closer to $1,500 a share, it looks far more reasonable. I wouldn't say they're attractively priced, but they're probably more close to fairly valued.
Sure. So many elements to take into consideration for us as investors. Of course, the technical fundamentals, market sentiment, and if you actually just trust the story that the company is looking to share. Let's get into some of those stocks to consider adding to your portfolio as we head into 2019. Let's actually take a look at the financial services sector here by combining potentially two companies that have been in the headlines recently in South Africa. Nedbank certainly presenting an opportunity, some exposure to East Africa, if I'm not mistaken, and Old Mutual on its recent return back home this year was quite a significant announcement that came through from that entity.
So Nedbank, I think, is, this is a SA story. So we believe that South Africa is in a better position today than it was a year ago. And whilst, as we mentioned earlier, the ship doesn't turn very quickly, it turns very slowly, but we think that the SA environment picks up from here. And Cyril Ramaphosa, we believe, is doing the right things, saying the right things. How do we get these quick wins? It's through releasing some of this cash that sits on corporate balance sheets, which he's trying to do. When you look at the credit cycle, it's been fairly depressed at the moment, and that's specifically due to corporates not been borrowing. So if we get a turn in the credit cycle, we believe that it's highly geared to, or banks' earnings are highly geared to the credit cycle, and as a result, Nedbank is probably best positioned to
Even with all the competition in the financial services space, right? Discovery launched a bank, Time Digital Bank, and other things.
New entrants are going to shake up the landscape.
So these banks are, I mean, they're ripe for disruption, absolutely. But when you think about Discovery Bank, Time, and Bank Zero is the other one. They're targeting the retail space. Nedbank, if you're looking for a bank that's got corporate exposure, Nedbank historically, whilst they're making good headway in the retail space, historically Nedbank's been seen as your corporate bank. So we believe in looking at the valuations. Banks got ahead of themselves earlier this year when everyone, sentiment picked up and everyone got excited on the back of Ramaphosa being elected. Yeah. Now we suddenly, you can pick up Nedbank at 1.4, 1.5 times book value, a dividend yield of, close to 6%. They're looking fairly attractive at the moment. So we inherited some Nedbank on the back of Old Mutual coming home, unbundling the managed separation, and we've increased our position in there.
Let's talk about Old Mutual. The headquarters just right next door from CNBC Africa Studios right here. And perhaps if this is one that you also consider here, Adrian, before we get Andrew's perspective on it.
Yeah, Gugu, we've got exposure to both stocks. I think sympathetic with Andrew's argument, we've considered Old Mutual the preferred point of entry because by virtue of holding Old Mutual, you had a large exposure to Nedbank. Valuation on Nedbank has been attractive and has remained attractive. So I would agree with the suggestion that at a price book of less than 1.5 and a fairly compelling dividend yield, there is a good case to be made there. I'm not as convinced that their corporate business won't be squared up to by the new entrants. Bank Zero might be the one to look to on that score. And of course, it's a highly contested landscape, even in the absence of new entrants. But their book is strong, the business is well managed. The retail presence has been sort of a long-standing thorn in the side. But coming back to Old Mutual, the embedded value in Old Mutual makes for a strong investment case. It's got compelling diversification cross-border. So their sub-Saharan business, I think, adds to our interest. And so we hold positions in both stocks.
Positions in both stocks. Andrew, this must be an interesting one for you, given that your blood is green itself.
So I mean, I think they're doing the right things. From a capital allocation point of view, coming home, selling off, the non-core or separating out of the non-core assets, returning cash to shareholders. We saw a special dividend this year. We expect that there could be a potential special dividend next year as they sell off their South American business. So they're doing the right things. Valuation, when you compare it to the likes of a Liberty or an MMI, the valuation is very compelling. I think the market's taking a wait-and-see approach here. Fairly unknown management team, new. There's a lot of changes still going on at the moment from a management team perspective. So I think the market's seen if they can deliver on the strategy. But all the divisions are doing well. They expect growth, 2% plus of nominal GDP, which on these valuations I think looks fairly reasonably priced.
Sure, and I guess that exposure as well to the increasing growing consumer base across sub-Saharan Africa also adds to a positive regarding the numbers and growth potential there.
Yeah, absolutely.
Indeed. Well, those are just a few stocks for us to consider. When we do come back from the break, we'll take a look at the likes of Datatec, Telkom and Altaba. If you want to find out how they, of course, present an interesting value proposition, stay with us after the break. But in the meantime, feel free to keep your emails coming by sending them to portfoliowatch@abn360.com or tweet us at CNBC Africa, #PortfolioWatch. We'll be back right after this.